Something doesn't add up in today's market. The 10-year Treasury yield is pulling back toward 4.05%, yet equities aren't exploding higher. SPY closed near 68.1, QQQ struggled around 600, and after-hours action looks hesitant. So the question is simple. If yields are falling, why isn't the market stronger? Let's break down what's actually happening beneath the surface. Today, the 10-year yield, TNX, moved lower toward the 4.05% zone. Normally, falling yields are supportive for equities, especially growth stocks. Lower yields reduce discount rates. Lower discount rates support higher valuations. But here's the nuance. The move in yields today was not aggressive. It was controlled, measured, almost cautious. That suggests this isn't a panic move into bonds. It looks more like repositioning. And when yields drift lower without panic, equities don't necessarily surge. They wait. The bond market might be stabilizing, but it's not signaling a full risk-on shift yet.
SPY closed slightly positive at $681.75, but after hours shows minor weakness. The key level remains around $681, the previous close zone. Price attempted to push higher intraday, but failed to hold the upper range. That tells us something important. Buyers are present, but they are not aggressive. Volume wasn't explosive. Momentum wasn't expanding. This looks like controlled consolidation, not breakout behavior. If SPY holds above $677 to $680, structure remains intact. But if we lose that base, we could see a deeper retest toward lower support levels. The market is balancing here, not breaking, not accelerating, just balancing.
QQQ closed around 601.92, but slipped after hours toward 600.50. That 600 level is psychologically important. It acted as intraday support earlier, and now we're testing it again. Tech stocks are more sensitive to yield movements, so if yields truly continue lower, QQQ should outperform. But the fact that QQQ isn't aggressively bouncing suggests one of two things. Either the yield drop is temporary, or investors are cautious ahead of upcoming macro data. This is not fear, but it is hesitation, and hesitation at highs often leads to volatility expansion. We're in a market environment where inflation data remains sticky. Rate expectations are shifting week to week, and positioning is already elevated. When positioning is crowded, markets react differently. Good news doesn't create strong upside. Bad news creates faster downside. Right now, bonds are cooling slightly, but equities are not chasing. That's a divergence worth watching. If yields continue to trend lower and break below 4%, that could unlock stronger upside. But if yields stabilize here and bounce, equities may struggle. The bond market is leading the narrative. Stocks are reacting, not initiating. Here's the structure. If TNX breaks below 4.05% and accelerates lower, bullish for tech. If TNX reverses and reclaims higher levels, pressure returns to equities. For SPY, watch 680. For QQQ, watch 600. Those are short-term battle lines. This is not a breakdown, but it's not a breakout either. It's compression, and compression always precedes expansion. The only question is direction. If you follow daily macro structure and yield-driven moves, subscribe. This market is not random. It's reacting to capital flows, not headlines. And right now, the bond market is quietly setting the tone. Let's see who moves first tomorrow, stocks or yields.